Have you ever looked at a chart, or I mean, maybe even your own retirement account, and just felt this sudden, terrifying realization that the rules of the game just changed?
Like they changed while you were fast asleep.
Exactly. Welcome to the Deep Dive. I'm your host, and today we are unpacking a moment in time that frankly feels like a before and after line drawn in the sand of global finance.
And I'm thrilled to be here to break this down with you because we're talking about February 2026.
Right. The global market's reliance on historical data completely and utterly fractured.
All those comfortable, smooth back tests that everyone has been using for the last decade, broken. It really is a paradigm shift.
It's a brutal wake-up call, and today's deep dive explores the monumental issue number 007, the March 2026 edition of the ASWA 94U Market Pulse magazine.
Which, honestly, calling it a magazine almost feels like an understatement at this point.
It really does. It's a massive treasure trove of quantitative analysis, macroeconomic data, and community-driven trading strategies.
It's essentially a survival guide for what we are now calling the Great Divergence.
The Great Divergence. I like that. And our mission today is to help you, the listener, navigate this exact divergence. We're going to extract the vital signals from an overwhelming amount of noise.
Because there's a lot of noise right now.
So much. We need to understand exactly why legacy risk models are failing spectacularly. We'll look at the geopolitical shocks that broke the algorithms, the AI displacement wave that is rewriting corporate structures, and, most importantly, where the smart money is actually flowing.
The real institutional capital.
Right. But before we get to the literal cruise missiles and the AI existential dread, we do have some major housekeeping from the ASWA 9 community.
And this first point is less housekeeping and more like tying yourself to the mast of a ship in a storm.
Definitely. The editorial team has three massive structural announcements. Number one is a regulatory milestone. The Official Information Commissioner's Office, or ICO, registration of their UK entity.
Right, A&K Quant Holdings Ltd.
Exactly. And for you as a participant in their ecosystem, this isn't just, bureaucratic paperwork to gloss over.
Not at all. In an era where data is literally the most valuable asset on Earth, this registration guarantees top-tier data security and privacy compliance.
It means every participant utilizing their store benefits from the highest standards of IP protection.
They've partnered with a top-tier KYC provider, and they're actively working alongside UK authorities for formal cybersecurity certification.
It's about establishing a fortified perimeter around the community's research, which is critical when you look at what they are actually executing.
Which brings us to the second announcement, the institutional leap.
Right. ACO and Kquant Holdings Ltd. has received official approval from Interactive Brokers IBKR for a holding institutional master account.
That is huge.
Let's pause here. For anyone listening who uses IBKR for their personal retail account, what's the actual difference? Why is an institutional master account such a massive deal?
Well, it's an entirely different tier of access. Your standard retail account is designed for an individual trading their own capital. An institutional master account is designed for corporate entities managing complex, multi-layered strategies.
And in this specific case, it's a strictly non-leveraged cash account, right?
Correct. Zero margin risk. But it's equipped to execute real-time trade operations across stocks, ETFs, options, and futures markets on every major global exchange.
Being vetted and accepted by a brokerage powerhouse like that for an institutional master account, that's the ultimate proof of concept.
It requires rigorous compliance, anti-money laundering checks, proof of operational competency. It really separates the hobbyists from the true quantitative firms.
You don't get that account by trading meme coins on your phone.
Definitely not.
And speaking of elevating the standard, the third announcement is all about educational excellence. The team is celebrating the graduation of the very first Entitrader Bootcamp student.
A huge milestone.
The whole mission of that educational wing is to replace superficial, narrative-driven retail habits with strict, data-driven financial literacy.
You have to navigate a demanding curriculum and pass incredibly strict performance requirements to get that certificate.
So a massive congratulations to that first graduate. You're proving that the transition from gambling to scientific quantitative trading is entirely possible.
It's a foundational shift in methodology. moving from reacting to the news to systematically exploiting statistical edges.
And if we look back at the scoreboard for February 2026, you absolutely needed that cold, data-driven approach.
Because the market movements were violent.
Violent, disconnected, and designed to punish the consensus.
Exactly.
So we have billions bleeding out of certain sectors, massive regulatory shifts, a chaotic macro environment. Let's look at what actually moved the needle. Segment 1, market sentiment and top movers. Let's start with Forex.
The Great Rotation.
The top gainer was AUD-JPY, surging plus 2.99%. We also saw AUD-CAD up 2.42% and AUD-USD up 2.38%. On the flip side, the biggest loser was GBP-AUD, tanking a massive minus 3.75%. What is the fundamental story driving this?
The overarching theme of February was stark policy divergence.
The dovish versus the hawkish.
Precisely. The Australian dollar emerged as the standout performer because of a hotter-than-expected January CPI print. Inflation in Australia wasn't cooling the way models predicted.
Which reinforced the Reserve Bank of Australia's hawkish posture.
Right. They actually surprised markets with a 25 basis point hike, pushing rates to 3.85%.
So you have a tightening RBA, aggressively trying to cool their economy.
Stacked against a Bank of Japan that is only gradually, almost reluctantly, tightening.
Former BOJ Governor Kuroda even suggested that 157 represented excessive weakness for the yen.
But verbal intervention did very little to reverse the sentiment. The carry trade, where you borrow in a low-yielding currency like the yen to buy a higher-yielding currency like the Aussie, is very much alive.
Traders poured into AUD-JPY to capture that yield differential.
He did?
And what about the British pound? It got absolutely hammered against the Aussie, down nearly 4%.
The pound was among the weakest G10 currencies because of severe domestic headwinds. UK unemployment rose to a 5-year high of 5.2%.
And wage growth cooled to 4.2%.
The Bank of England held rates at 3.75% in a very tight 5-4 vote. But the slowing growth combined with sticky inflation of 3.4% painted a textbook stagflationary picture.
The economy is shrinking, but prices are still rising, the worst of both worlds.
Exactly. Markets rapidly priced in a March rate cut, which caused GBP-USD to break below its 50-day moving average, dropping 1.53% on the month to test major support near 1.3370.
When you pit the weakening stagflationary UK economy against the tightening inflation-fighting Australian policy, that plunge in GBP-AUD is just the math working itself out.
It's inescapable.
Okay, let's pivot from the math of sovereign nations to the absolute Wild West, crypto. Extreme fear seems to be the overarching emotion right now, but the outliers are wild.
Always are.
The top gainer in the magazine's data was a low cap called LIT-USD, which exploded an incomprehensible plus 1,221.6%.
Massive.
We also saw DCR-USD up 60.9% and DXY-USD up nearly 40%. But the major story, the one dominating the sentiment analysis, is the bleeding. Privacy coins suffered brutally.
ZEC-USD was the biggest loser, down 27.8%.
XMR down 16.81%. But what really caught my attention was that the heavyweights got crushed. Bitcoin dropped 14.94% in February, sliding to the mid-65,000s.
And Ethereum fared even worse.
Dropping a staggering 19.81% during the month, hovering near the 2,000 mark as altcoin weakness deepened. What happened here?
The defining moment for crypto in February was the fifth. It was a violent flush that wiped out billions in leveraged positions in a matter of hours.
Billions.
Bitcoin cratered through multiple technical support levels, triggering cascading algorithmic liquidations. Cumulative crypto futures open interest fell to multi-month lows of $93.5 billion.
So this wasn't just selling, this was a forced exodus of speculative capital.
A rapid one. The Fear and Greed Index plunged to 11.
One of the lowest readings on record.
It signals maximum retail capitulation. People were panic selling at the exact worst moment.
Maximum retail capitulation. But wait, we've spent the last year hearing about the institutional adoption narrative. The spot ETFs are live, BlackRock is accumulating, corporate treasuries are buying. How does a 15% drop happen when the biggest players are supposedly accumulating?
That is the great paradox of February. This massive drawdown unfolded against a backdrop of unprecedented regulatory clarity and advancing institutional infrastructure.
Bipartisan legislation advancing in the U.S.
BlackRock's Jay Jacobs insisting it's still early days for Bitcoin adoption. But none of that narrative mattered to the algorithms in February.
Prices came.
And price was falling due to broader macroeconomic fears. However, if you look at the quant signals, you see exactly what the institutions were doing.
What were they doing?
On Deribit, the primary crypto options exchange, 1-month Bitcoin puts traded at a 7% premium to calls and put spreads accounted for 75% of total block flow.
Hold on, let me play translator for a second. Put spreads accounting for 75% of total block flow. For the listener who doesn't trade crypto options, what is a put spread and why does this show us what the big money was doing?
Sure. A put is an options contract giving you the right to sell an asset at a specific price. You buy a put when you want insurance against the price dropping.
Like buying fire insurance.
Exactly. A put spread is a more advanced strategy where you buy a put at one price, but simultaneously sell another put at a lower price. It limits your maximum profit, but it significantly reduces the cost of the insurance.
And block flow.
Refers to massive off-exchange institutional trades. So when put spreads make up 75% of that massive institutional volume, it tells us that the whales, the giant funds, were actively buying precisely calculated downside protection.
They saw the macroeconomic storm coming.
They got insurance, and they sat back while the over-leveraged retail traders got liquidated.
So retail gets washed out, institutions hedge their downside, and privacy coins get absolutely decimated because regulators are closing the net. It sounds like a severe risk-off environment. Did that translate to international stocks?
It did, but it was a massive, violent capital rotation rather than a uniform panic. February marked a pivotal inflection point for global equities.
The catalyst was sudden, and it completely redefined the tech sector.
On February 3rd, the launch of Anthropic's Claude Cowork platform triggered what Jefferies traders dubbed the SaaSpocalypse.
The Spocalypse.
It erased an estimated $285 billion in software market capitalization in a single session.
$285 billion in one session.
The tech-heavy NASDAQ composite shed 2.3% for the month, its worst month since March 2025.
Cybersecurity stocks like CrowdStrike and Zscaler lost 10% in a single day. Solar and peripheral tech took massive hits. Shoals Technologies collapsed 44%. I have to stop you there. Why this sudden existential panic from investors who have loved tech for a decade?
Because the fundamental narrative shifted overnight. For years, the thesis was that AI makes everything more valuable, it makes software companies more efficient.
Right.
But suddenly, with the release of these new agentic AI platforms that can perform complex multi-step engineering and administrative tasks autonomously, the narrative inverted.
It became AI destroys incumbent business models.
Investors suddenly realized that a company charging $100 a month per user for project management software is obsolete if an AI agent can do that same task natively for pennies.
The trailing stop losses on these incredibly expensive SaaS companies weren't just optional risk management anymore.
They were existential requirements.
Yeah.
So capital rotated decisively out of highly valued U.S. technology and into markets perceived as more insulated from AI disruption.
And where did all that capital flee to?
Tangible assets, value, and Asia. The MSCI Asia Pacific Index surged roughly 7%, strongest February since the index's inception in 1998.
South Korean tech names, specifically those riding the AI hardware supply chain rather than software, surged nearly 20%.
South Korea drew over $1 billion in foreign inflows during February alone. European markets benefited from Germany's fiscal expansion.
And within the U.S., value and cyclical sectors thrived. The top stock gainer globally, according to the magazine's data, was DaVita, DVA, a physical dialysis clinic operator which skyrocketed 34.20%.
Industrials, energy refiners, and packaging companies posted double-digit advances. It was a structural rotation away from narrow, concentrated tech into cheaper, diversified assets with tangible earnings drivers.
So the golden rule, the big takeaway from this first segment is this. The market didn't just lose money, it violently rearranged where the money lives. And the survival of your portfolio depends entirely on understanding the difference between the narrative of the future and the reality of the present.
Precisely. And that rearrangement was dramatically accelerated by physical, real-world events. Which brings us to the core of why quantitative models failed in February.
Segment 2. Major financial and geopolitical shocks. While Silicon Valley was having an existential crisis over software, the physical world reminded us that hardware, specifically military hardware, still runs the global economy.
Operation Tehran.
Right. And for the listener, we're looking at this purely through the lens of market impact and quantitative risk. impartially reporting the facts on the ground as detailed in the issue.
This is the event where we saw the quantitative models actually break in real time.
The reporting notes that at 0347 UTC on February 28th, the first wave of American and Israeli cruise missiles struck targets across 6 Iranian cities.
By sunrise, strikes on Tehran, Isfahan, Karaj, Kermanshah, Qum, and Tabriz had destroyed missile production facilities and cratered nuclear enrichment infrastructure.
U.S. and Israeli officials confirmed the killing of Supreme Leader Ayatollah Ali Khamenei in a direct hit on a leadership compound in northern Tehran. President Trump announced major combat operations to prevent the regime from acquiring nuclear weapons.
And the retaliation was immediate. Iran's Islamic Revolutionary Guard Corps launched retaliatory ballistic missile strikes against American and Israeli installations across the Gulf.
Missiles targeted the U.S. Navy's 5th Fleet headquarters in Bahrain.
Drones struck near naval compounds. Missiles were intercepted over Abu Dhabi and Kuwait, but there were impacts. A fire erupted near a hotel on Dubai's Palm Jumeirah.
Saudi Arabia confirmed missiles targeted Riyadh and its eastern province. This effectively killed the Iran rapprochement of 2023 brokered by China. It was a regional ignition.
It was. So, as a quant sitting at a desk managing billions of dollars, how do you even begin to price in a regional war that targets the literal energy arteries of the planet?
The magazine lays out a scenario tree for crude oil. Walk us through how the market digested this.
For crude oil quant models, the singular key variable in this region is the Strait of Hormuz. It handles approximately 21 million barrels per day.
Roughly 21% of global petroleum consumption.
The market instantly mapped out 3 distinct scenarios. First, the base case, or contained scenario, pricing Brent crude between $78 and $85.
Assuming strikes remain limited to military targets, the strait stays open, tanker insurance premiums spike heavily, but physical oil flows continue.
That's the base case. Then the escalation scenario prices Brent at $85 to $95. Here, Iran conducts limited harassment operations in the strait.
Inspecting tankers, deploying naval mines, firing warning shots.
Physical disruption is intermittent, but severe enough to trigger force majeure clauses, forcing shipping companies to reroute cargoes around the Cape of Good Hope.
That detour adds 10 to 14 days of transit time.
And $2 to $4 per barrel in pure freight costs, instantly driving up the baseline price of crude globally.
And the worst-case scenario, the true tail risk.
The tail scenario prices Brent at $100 plus. This involves a sustained closure of the strait through heavy mine-laying or anti-ship missile salvos against commercial vessels, or direct attacks on oil terminals in Saudi Arabia's Eastern Province or UAE port facilities.
OPEC's spare capacity of about 5.5 million barrels per day would be activated.
But physical delivery constraints would push prices well above fundamental equilibrium. Options markets immediately steepened the Brent crude volatility surface, with the 25 delta call skew widening to levels not seen since the 2003 Iraq invasion.
Pause. We have to translate that for the audience. The 25 delta call skew widening. Know what that means? You know what that means. But for the person driving to work right now, what is the market actually doing?
Excellent point. Let's break it down. In options trading, delta measures the probability that an option will finish in the money. A 25 delta call option is essentially a bet that has roughly a 25% chance of paying off.
It requires a significant, rapid jump in the price of oil.
The skew is the difference in price between the options betting on a massive price increase versus the options betting on a massive price drop.
Right.
When the 25 delta call skew widens to levels not seen since 2003, it means institutional traders are suddenly willing to pay an astronomical, desperate premium for insurance against oil prices skyrocketing. They were pricing in the sheer terror of $120 or $150 oil.
The market buying fire insurance while the house next door is already engulfed in flames. But the real crisis wasn't just the oil price. It was how all the different asset classes behaved together.
The magazine calls it a quant crisis.
Explain the correlation spike.
This is the most terrifying part for a quantitative strategist. February 28th demonstrated that a high-impact geopolitical event destroys diversification.
Equity volatility, crude oil volatility, and FX volatility,
which usually have moderate or even positive correlations during normal geopolitical events, they moved in near-perfect lockstep. They produced correlation readings above 0.90 across all three.
So to put that in plain English,
Yeah.
let's say I'm a risk manager. I've built this beautifully diversified portfolio. I have stocks, bonds, commodities. My model says, hey, if stocks crash, my bonds will go up and my oil holdings will balance it out.
Right.
But what you're saying is when correlation hits 0.90, that entire theory burns to the ground. Everything panics at the exact same time in the exact same direction.
Precisely. If you're running a risk parity portfolio that explicitly assumes equities, commodities, and currencies won't all crash together, your diversification benefits disappeared precisely when you needed them most.
Your portfolio experienced drawdowns well beyond your modeled worst-case scenarios.
Let's talk about VAR, value at risk. It's the standard metric institutions use to estimate how much money they could lose on their worst day. If your VAR framework uses rolling historical correlations, looking at the last 3 years of relatively peaceful data, you will systematically underestimate your tail risk.
The old playbook of hedging Gulf military risk with modest crude oil call spreads is dead.
Geopolitical regime changes restructure the correlation matrix itself. The quant playbook for Gulf geopolitical risk is no longer optional. It is foundational.
So that's the golden rule for risk managers. Historical correlation is a luxury of peacetime. When the missiles fly, correlation goes to 1. But while the Middle East is fundamentally restructuring energy markets, the U.S. Supreme Court decided to drop a constitutional earthquake on global trade. Let's talk about the SCOTUS tariff wall. What happened here?
It was a massive structural shock. On February 20th, the Supreme Court ruled 6-3 to strike down President Trump's IEEPA-based tariffs.
IEPA being the International Emergency Economic Powers Act, the landmark case of Learning Resources v. Trump.
The court ruled that the executive branch had overstepped its emergency powers, effectively voiding the tariff regime that had collected roughly $269 billion.
Markets initially rallied wildly on this news. Retailers, auto manufacturers, anyone reliant on cheap foreign components saw their margins instantly expand on paper.
But that rally was a mirage. It lasted hours. As the market digested the ruling, a massive $175 billion refund vacuum hung over the Treasury. Where was that money going to come from?
And before the closing bell even rang, the administration announced a replacement 10% global levy under Section 122 of the Trade Act.
Treasury yields rose violently across the curve. The U.S. dollar spiked, then reversed as algorithms tried to process the net impact.
For swing traders, this was a textbook lesson. Widely anticipated binary events rarely produce clean one-directional moves.
Importers facing this sudden, chaotic shift in effective tariff rates on Chinese and Indian goods began frantically front-loading orders, hoarding inventory.
This created a short-term GDP boost in the data, but it masked the underlying economic softness and completely scrambled global supply chains.
It's like a massive game of whack-a-mole with global shipping.
And just as the market is digesting a ground war in the Middle East and a constitutional crisis over tariffs, we get the war shock. Regime change at the Federal Reserve.
This represents a profound shift in monetary policy expectations. In January, President Trump nominated Kevin Warsh to succeed Jerome Powell as a Federal Reserve Chair.
Warsh is a former Fed governor and a known hardcore inflation hawk. He previously published op-eds calling the Fed's current leadership broken and demanding aggressive reduction of the Fed's $6.6 trillion balance sheet.
So we have a super hawk taking over the money printer. How did the market react to the realization that the era of easy money might actually be over?
It obliterated the debasement trade. Any asset that relied on the narrative of the U.S. dollar collapsing got hit hard. Gold plunged 16% intraday, dropping from $5,595 to below $5,000 before settling at $4,745.
Its worst single session since 2013. Silver crashed 31.4%. Bitcoin had its largest drawdown since 2022.
Morgan Stanley reported massive forced rebalancing as leveraged ETFs tracking these metals triggered automatic algorithmic sell orders.
The overarching thesis that political pressure would force the Fed to subordinate the dollar and devalue the currency collapsed on a single personnel announcement.
But the magazine points out a really weird contradiction here in the bond market. They call it the Great 2026 Twist.
Yes, this is where it gets highly complex and counterintuitive. Despite expectations of accelerated quantitative tightening, meaning the Fed selling off its assets and shrinking the money supply, the 10-year Treasury yield actually drifted down to 4.09%.
It was a bull flattener driven by safe haven demand. Stop right there. Bull flattener. I know we have bond desk traders listening, but for the rest of us, What is flattening and why is it bullish?
If the Fed is about to dump trillions of dollars of bonds onto the market, shouldn't bond prices crash and yields spike? It's a great question because it defines basic supply and demand.
Let's visualize the yield curve. Normally, if you lock your money up for 10 years, you demand a higher interest rate than if you lock it up for 2 years.
A flattener happens when the gap between the 2-year yield and a 10-year yield shrinks. A bull flattener specifically means long-term interest rates are falling faster than short-term rates. It's bullish for the price of long-term bonds.
So what happened was the sheer terror of the geopolitical escalation in the Middle East overrode the mechanical supply pressure of the Fed.
Investors were so scared of the global environment that they flooded into 10-year U.S. Treasuries as a safe haven, driving the price up and the yield down, even though Warsh is promising to sell.
So the twist is the market pricing in a paradox. Derivatives desks began pricing a novel QT for cuts regime, quantitative tightening for cuts.
Shrinking the money supply while simultaneously lowering the baseline cost to borrow to support a fragile economy. It literally has no historical precedent.
It hurts the brain just thinking about how an algorithm is supposed to price that. And speaking of algorithms, let's look globally. We've got the Fed doing this unprecedented twist, but what about the rest of the world?
Global central bank divergence creates a chaotic cross-currency carry environment. The European Central Bank kept rates unchanged at 2.0%.
Christine Lagarde stressed a good place narrative as Eurozone flash CPI actually fell below target to 1.7%. They face absolutely no urgency to cut rates.
Meanwhile, the People's Bank of China is aggressively trying to stimulate, and the Bank of Japan is reluctantly tightening. Every major central bank is playing a different game.
And looming behind all of this public market volatility is the $2 trillion shadow of private credit risk. The ASWA 9 issue mentions private credit's cockroach problem.
The cockroach problem. If you see one bad loan, there are 1,000 hidden in the walls.
Exactly. The idea is that contagion risk is building in the shadows where traditional valuation metrics like mark-to-market accounting simply don't reach.
Private equity firms have been lending to each other, creating incredibly complex webs of illiquid debt. In a war economy with spiking geopolitical risk and a hawkish Fed chair, these illiquid private credit portfolios are a massive systemic vulnerability waiting for a catalyst.
So the big takeaway for segment 2. We are in an era of unprecedented macro contradictions. You have a hawkish Fed causing bond yields to drop. You have global tariffs being struck down only to be instantly replaced. The models are breaking because human panic and geopolitical tail risks do not fit neatly into a normal distribution curve.
Okay, let's take a breath. We've covered a Middle East conflict, a Supreme Court tariff battle, a new Fed chair, and a $2 trillion private credit shadow.
But honestly, segment 3 might be the most impactful for the daily lives of our listeners, the AI displacement wave and the tech sector reckoning. We hinted at this with the Syspocalypse, but the sheer scale of the capital moving here is terrifying.
Let's start with OpenAI's $110 billion mega round.
That funding event completely redefined capital formation in Silicon Valley. It proved that the intelligence crisis is no longer theoretical, it is highly operational.
We're no longer talking about chatbots writing emails. We're talking about autonomous reasoning engines capable of executing complex workflows. And the immediate corporate response to this realization was chilling.
Yeah, look at Block, Jack Dorsey's company. They laid off 4,000 employees, and they didn't hide behind the usual corporate PR speak of macroeconomic headwinds or restructuring.
They explicitly said they were replacing these workers with an internal AI coding tool called Goose.
Goose. They cited massive productivity gains from Goose in functions across customer support, code review, compliance monitoring, and fraud detection.
These are not peripheral low-level tasks. They are the core operational workflows of a financial technology company. And the market's message was brutal but clear. Fewer humans equals higher margins. Therefore, buy the stock. Block's stock surged 24% on the announcement.
Wait, I have to play devil's advocate here. Is Goose really that capable, or is AI just providing convenient corporate cover for Jack Dorsey to trim the fat during a broader tech downturn? 4,000 people is a massive operational chunk to hand over to an algorithm. Are we sure this isn't just a brutal cost-cutting measure disguised as a technological leap? There's a vital question. Undoubtedly, there is an element of AI washing and corporate layoffs right now. CEOs know Wall Street rewards the AI narrative, but you cannot ignore the underlying capability jump.
The ASWA 9 analysts point out that the marginal cost of compute has officially crossed the threshold of human labor for specific, structured tasks.
If Goose can write boilerplate code, instantly cross-reference compliance documents, and handle Tier 1 customer support natively, retaining 4,000 employees to do the same tasks becomes a fiduciary failure in the eyes of shareholders.
I want to use an analogy to explain this shift. Imagine you run a massive factory, and for decades, your most expensive cost has been human labor. Suddenly, overnight, you realize that your most advanced robotics, your most capable machinery is now cheaper than the electricity required to keep the lights on for the human workers.
It is a terrifying realization for white-collar workers. The factory floor is coming for the office building.
It is a permanent structural change rather than a cyclical adjustment. And we saw the exact same dynamic play out with Anthropic's release of Claude Code, which triggered that SysApocalypse.
The rollout of these AI coding agents wiped $31 billion off IBM's market cap in a single session. Why? Because the cost of building and maintaining quantitative infrastructure is collapsing.
The magazine notes that building alpha-generating infrastructure like backtesting engines, high-frequency execution systems, and institutional risk frameworks has historically required teams of 15 to 30 specialized engineers at annual costs easily exceeding $5 million.
And now, AI coding agents are compressing that requirement to 3 to 5 senior engineers supervising autonomous code generation. They're cutting infrastructure costs by 60 to 70% while accelerating deployment cycles from months to days.
This fundamentally democratizes the field. Smaller, agile funds can now access institutional-scale engineering, eroding the deep technological moat that legacy software companies and large quants have maintained for decades.
IBM's consulting business, which relies on armies of engineers billing by the hour, suddenly looks incredibly vulnerable.
So AI is destroying the moat for big tech consulting and legacy software while making small, lean quant teams insanely powerful. But what about the company making the physical chips that power all this?
NVIDIA's $68 billion paradox.
They posted record earnings, massive revenue growth, right? So why did the stock drop 5.5% on the news?
This raises an important question about market psychology and the concept of peak margins. The market suffered from a dual fear regarding NVIDIA.
First, there is the historical fear that NVIDIA has reached peak cyclical margins and simply cannot sustain this level of explosive growth indefinitely. The law of large numbers eventually catches up.
But the second fear is the broader AI disruption fear. The market realized that buying the shovel seller is risky if the gold miners are using their shovels to dig their own graves.
Digging their own graves. That perfectly encapsulates the SaaS sell-off. If your clients are software companies and software companies are getting destroyed by AI agents, eventually your chip orders will dry up.
But from a purely quantitative perspective, this tech reckoning caused something called the Great Factor Divergence.
Break this down for us. What is a factor model and how did it break?
This is critical for anyone running automated equity strategies. A factor model categorizes stocks based on specific attributes or factors, like value, size, volatility, or momentum.
If you run a momentum strategy, your algorithm automatically buys stocks that are going up and sells stocks that are going down, assuming the trend will continue.
In February, there was a 5 sigma correlation collapse between the momentum factor and broader market sentiment. The correlation dropped from 0.86 down to 0.33 over just 3 weeks.
For the listener, a 5 sigma event is essentially a statistical anomaly so extreme it should almost never happen in your lifetime. It's a black swan in the data. How does a 5 sigma collapse happen?
It happens when a model becomes blind to context. Momentum algorithms had been blindly chasing narrow AI sector gains for 18 months. They transformed what portfolio optimizers thought was a diversified style factor into an unhedged concentrated bet on just 7 megacap tech stocks.
When the fundamental narrative shifted and the SysApocalypse hit, the momentum factor broke. Algorithms violently compounding stop losses generated massive cascading drawdowns.
So the lesson here is that when a single thematic narrative like AI captures an entire style factor, diversification becomes a lie.
The label on your portfolio might say diversified momentum, but the underlying risk was concentrated entirely into an AI proxy. The systematic quants who actively monitored the narrative and manually overrode their legacy risk models survived. Those who trusted the passive, automated factors were washed out.
Exactly. And while all this high-tech drama is unfolding, what is corporate America doing? They authorized a record $233 billion in buybacks in February.
They're literally trying to buy the dip with their own stock during the S&P 500's worst month since March.
It highlights a massive disconnect. You have corporate insiders buying their own stock, trying to prop up the price, signaling they believe their companies are undervalued, but you have systematic momentum funds frantically selling to stop out of their positions.
And hovering over all of this is sticky inflation. The January CPI came in at 2.4% year over year. That keeps the macro backdrop highly precarious.
The 10-year yield broke below 4% on that flight to safety bid due to geopolitical escalation. But the inflation data complicates the Fed's outlook, strengthening the higher-for-longer voices within the committee.
So the takeaway for segment 3, the AI revolution has moved from creating software value to destroying corporate headcount. And if your investment strategy is relying on blind momentum, you are effectively driving a race car while staring exclusively in the rearview mirror.
Okay, let's move to segment 4, explanations for market movements and institutional positioning. We've talked about what happened and why it broke the models, but I want to know what the true financial giants were doing right before the storm hit. Let's decrypt the 13F filings from Q4 2025.
First, translate 13F for us. That's the quarterly form big funds have to file to show what they own, right?
Yes. 13F filings are mandatory quarterly reports filed by institutional investment managers with over $100 million in qualifying assets. They give us a snapshot of institutional capital positioning as of December 31st, 2025.
Which was exactly right before the February chaos.
Now, there is a lag, but the aggregate pattern here is unmistakable. Institutional money was actively de-risking long before the retail market panicked. They were concentrating their core AI tech positions, rotating heavily into energy, financials, and defense adjacents, and building unprecedented cash buffers.
They bought their hedges before the VIX volatility index spiked. The smart money wasn't surprised by February. They were prepared for it. Give me some specific names. What did the legends do?
Berkshire Hathaway is always the most scrutinized. Right. Under Greg Abel, who took the helm following Buffett's retirement, the massive $274 billion portfolio continued trimming Apple down 4.3% to 228 million shares.
They reduced Bank of America by 8.9%. What did they buy?
Energy. Chevron. They increased their Chevron holdings by 6.6% to 130 million shares. And crucially, Berkshire entered 2026 sitting on $382 billion in cash and short-term treasuries.
$382 billion in cash. They weren't just taking profits, they were literally bracing for impact. What about Stanley Druckenmiller? He's legendary for reading the macro winds.
Druckenmiller's Duquesne family office told an even sharper story. His tech exposure collapsed from 13.8% down to just 9.4%, which is its lowest level since 2021.
He completely exited major software names. Meta, ARM, MongoDB, SanDisk, all gone.
His top purchase, the Financial Select Sector SPDR ETF,
Yeah.
A broad macro bet on banks and insurance companies benefiting from the interest rate environment. He also loaded up on South Korea via the iShares MSCI South Korea ETF and bought 1 million shares of Micron.
Concentrating his AI bet purely on physical memory compute names rather than vulnerable software. He saw the SaaSpocalypse coming.
Yeah.
And David Tepper's Appaloosa.
Appaloosa told the emerging market rotation story. Their Chinese exposure dropped significantly from 28.5% to 19.5%, with zero new Chinese equity purchases for the first time in years. Capital shifted towards South Korea's memory leaders like Samsung and SK Hynix.
Even George Soros's fund management, which actually added to NVIDIA and Microsoft, rotated heavily into defensive index hedges and consumer staples. Tiger Global trimmed across its mega-cap AI positions.
The giants saw the AI software bubble stretching and the geopolitical cracks forming in the Middle East, and they took their chips off the table.
So if we connect the dots on the specific asset drops we saw in February, the picture is crystal clear. Let's run through them. Ethereum's nearly 20% drop and Bitcoin's 15% drop wasn't just isolated crypto volatility.
It was an extension of altcoin weakness slamming into macro rate fears and the Warsh nomination.
The Nasdaq Composite's 2.3% drop wasn't random. It was institutional AI jitters triggering a massive planned sector rotation out of software and into defense, energy, and Asian hardware.
Precisely. And in the Forex markets, the US dollar index, the DXY's 0.47% gain, which was its first monthly gain since October, was driven by policy divergence, making the US dollar a safe haven despite domestic turmoil and Supreme Court chaos.
Capital fled to safety. Meanwhile, GBP/USD dropping 1.53% was a direct result of sterling being hit by weak UK data and the Bank of England's stagflationary reality.
Everything is interconnected, and the institutions were positioned for the exact unwinding we witnessed.
Which brings us to the rule for segment 4. Follow the cash, not the headlines. When the smartest investors in the world start hoarding $500 billion in short-term treasuries and buying oil companies, you should probably stop buying overpriced tech software.
Which leads us directly into segment 5, investment implications and March 2026 catalysts.
What does this all mean for the listener? What are the key takeaways for traders sitting at their screens right now?
The primary takeaway is that you must ruthlessly abandon outdated backtests. Passive, factor-based strategies are dead in the current environment. A model calibrated on the benign, low-volatility environment of 2024 will blow up your account in 2026.
You need active, dynamic risk management that explicitly accounts for geopolitical tail risks.
You need to understand that correlations can and will spike to 0.90 across asset classes during a shock. If your strategy relies on the assumption that bonds will automatically hedge your equities during a crisis, you are exposed to catastrophic risk. Cash is a position, and agility is your only real edge.
So moving forward, what are the March 2026 catalysts we need to watch? The magazine outlines 4 massive ones on the calendar.
First is the Bank of Japan decision on March 18th and 19th. They are moving toward 1.0%. This is the single most underappreciated catalyst on the global calendar.
The BOJ's spring wage negotiation data will be critical to their inflation sustainability assessment. Any hawkish surprise from the BOJ could send the yen sharply higher.
Which risks a massive, violent unwinding of carry trades, specifically the AUD-JPY and USD-JPY flows we saw dominate February. If that unwinds, it drains liquidity from global markets instantly.
Second is the mid-March US CPI release, expected around March 11th or 12th.
This arrives just 6 days before the FOMC decision. It is crucial for Federal Reserve sequence expectations. With January CPI sticking at 2.4% and core PCE at 2.9%, any acceleration in inflation would effectively kill June rate cut expectations and embolden the hawks.
It creates a compressed volatility window where positioning errors will be magnified astronomically. Third is a Section 122 tariff clock.
Remember that Trump's replacement 10% global surcharge under Section 122 of the Trade Act expires automatically after 150 days, which hits by July 24th, unless Congress formally extends them.
March will provide the very first concrete economic data on how businesses are actually adjusting their supply chains under this new regime. Importers are front-loading orders right now.
The tariff landscape is a moving target, and traders must monitor the legislative calendar closely, because any friction in Congress will cause wild swings in import-heavy equities.
And the fourth is the Fed Chair Succession Watch, tracking Kevin Warsh's confirmation path. Senator Tillis has blocked Fed nominations, and Senator Warren opposes the position.
If confirmation extends beyond Jerome Powell's May 2026 term expiry, Vice Chair Philip Jefferson would serve as acting chair. A formal announcement or delay in March could violently reprice the entire rate cut trajectory, depending on how the Senate handles Warsh's structural shift toward a sound money doctrine.
It is an absolute minefield. But here's the good news. People are surviving this. People are thriving in this. And that brings us to segment 6, the community corner practitioners in the trenches.
This is where the ASWA 94U magazine really shines for me. It's not just Wall Street theory. It's showing us what retail traders turned quants are actually building to survive. Let's talk about Hossam.
Hossam's story is the perfect embodiment of the transition from manual craftsmanship to algorithmic precision. He is a Tunisian expat currently living and working in France. By day, he is a dedicated craftsman, utilizing his hands and visual intuition in carpentry and mobile interior decoration. He builds tangible things.
But by night, he spent 4 years navigating the unforgiving digital terrain of retail trading.
And like so many of us, he started with the illusions of retail chartism, drawing support and resistance lines, trend lines, Fibonacci retracements, looking for the visual escalier or staircase system on the charts.
He'd spend 4 to 5 hours a day manually backtesting on chart replay tools, feeling like an absolute genius in simulation mode. But when he transitioned to live market execution, the emotional toll, the revenge trading, and the inherent mathematical flaws of discretionary trading destroyed his accounts.
But he didn't quit. He evolved. He recognized that human psychology is the ultimate liability in trading. He engineered a statistical edge.
He built an expert advisor, an EA, an automated trading robot that successfully navigated and passed a funded next evaluation challenge in just 39 days.
He engineered strict, emotionless parameters, a $2,500 maximum loss limit on a $50,000 funded account. His EA has an ultimate failsafe. If the daily drawdown reaches 4%, the robot instantly severs connection and shuts down all operations until the following trading day.
You cannot revenge trade if the robot unplugs itself. His maximum recorded drawdown during the challenge was an incredibly controlled 4.5%.
And on his personal live account, applying slightly more aggressive risk profiles, he achieved a staggering 72% return on investment with a 34% drawdown. He enacts strict mathematical rules, refusing to increase lot sizing until the account equity organically reaches exactly $3,000. It's pure emotionless execution.
And now he's taking that decentralized mindset to the next level. He is building a secure messaging application, drawing inspiration from Trust Wallet, secured entirely by a randomly generated 12-word seed phrase. The goal is to broadcast his algorithmic trade signals directly to his peers without relying on third-party server vulnerabilities. It's brilliant. It's a carpenter building an impenetrable digital fortress.
It is a testament to intellectual humility and the absolute necessity of automation in modern markets. And the wider ASWA9 community is doing the exact same thing. Look at the analysis and predictions from other members highlighted in the issue.
Al-Ghafar, developed by contributor Revbin01, focuses specifically on identifying retail sentiment extremes to find squeezes or violent price reversals. They identified an 88% short retail position on AUD-USD, targeting a long squeeze entry because they know the retail crowd is usually wrong at the extremes.
Conversely, they saw a 90% long retail position on USD-CHF, positioning for a short squeeze, contrarian to the core, fade the retail panic.
Then there's the Minimax agent by Bettis Confir, providing high-conviction gold setups, XAU-USD, using a comprehensive automated scan of over 410 advanced technical metrics. It's setting optimal entry zones, clear risk parameters, and requiring technical validation across 13 distinct moving averages before firing a trade.
No human can process that much data manually.
Exactly. And AZML87's InnoRadar scanner is tracking institutional fund flows in real time. It's confirming exactly what the Q413F filing showed, capital rotating away from AI-concentrated tech toward defensive and international sectors.
The scanner identified natural resources and mining, capturing $7.5 billion in rapid inflows, while semiconductors suffered $6.5 billion in outflows.
And to track all this complex execution, the community isn't just relying on fragmented, messy spreadsheets. Contributor Bettis Confir developed the TradeMaster Journal. It's a sleek, offline-first, client-side trading journal built entirely on HTML, CSS, and vanilla JavaScript using local storage.
It natively understands the structural, mathematical nuances of different CFD asset classes. It automatically calculates based on 100,000 unit multipliers for Forex and accommodates 5 decimal precision, while instantly shifting to 1-point metrics for indices like the DAX 40. Complete data privacy, zero latency.
It is a masterclass in functional minimalism and data ownership. But perhaps the most impactful piece of quantitative research in the entire community corner is the Enter Detective feature on ICT order blocks.
Oh man, this is it. This is where dreams go to die. We have to spend some serious time here because ICT order blocks are the absolute darling strategy of TikTok trading influencers right now. If you open any social media app, you'll see a 20-year-old pointing at a chart claiming these specific blocks represent institutional footprints.
Hidden supply and demand zones left by central banks that create repeatable, high-probability entries.
It sounds incredibly convincing. So the ASWO9 team decided to actually put it to the test, from theory to hard code. Walk me through exactly how they tested this, because the mechanics are fascinating.
They applied rigorous scientific method to social media mythology. They coded a complete custom expert advisor, 631 lines of pristine MQL5 code to test one singular idea. Can ICT order blocks function as a profitable mechanical system?
They stripped away all the subjective human intuition that influencers use to explain away their losses and built exactly what the theory teaches.
The algorithm isolates the last opposing candle before a major price impulse. That's the order block. The rule is simple. Trade the return to that block with zeal or discretion.
Right, because if it's a true institutional footprint, it should mathematically hold up over time. What were the parameters of the test?
They ran this identical order block strategy, paired with an average true range-based stop loss for volatility adjustment across 9 different major assets, spanning 7 different time frames over a massive 5-year historical backtest.
Furthermore, to make it applicable to modern retail realities, they simulated strict proprietary trading firm rules within the code, a hard 5% daily drawdown limit, and a 10% total maximum drawdown limit.
If the algorithm hit those limits, the test was considered a failure. In total, they generated 54 rigorously controlled independent backtests.
So 54 tests, 9 pairs, 7 time frames, 5 years of tick data, and the carnage. What were the results?
Absolute unmitigated destruction. Out of 54 tests, there were 0 prop firm challenge passes. None. Almost all currency pairs completely wiped out the accounts. EOR USD, the most liquid pair in the world, lost money on all 7 timeframes.
GBP USD, AUD USD, NZD USD wiped out on all time frames within a matter of months. When they tested gold, the extreme volatility made the calculated order block zones mathematically far too wide to be usable with any standard risk management.
Wait, why did it fail so spectacularly? If price is supposed to react to these zones, what was the algorithm actually seeing in the data?
It failed because order blocks form constantly on a chart, but they get what the community calls mitigated, meaning price touches them, without actually reversing the macro trend. The zones, statistically speaking, have absolutely 0 predictive power. Price enters the zone, pauses for perhaps a single candle, and then blows right through it, triggering the stop loss.
The influencers on social media only show you the charts where the block perfectly held. They suffer from massive survivorship bias. The code proved that for every 1 order block that holds, 5 are instantly destroyed.
The edge is a mirage. That line from the magazine gave me literal chills. But I have to ask about market conditions. Did they account for slippage or spread or changing macro environments?
That's the most damning part. This destruction happened in the idealized conditions of a backtester. When you factor in real-world live market slippage, widening spreads during news events, and broker commission, the results are actually much worse. It is the ultimate psychological trap. It is discretionary trading masquerading as mechanical logic.
The influencer looks at a chart, instinctively knows the trend is up, and then retrospectively finds an order block to justify the trade they already wanted to take. But when you force a computer to trade every valid order block, the system bleeds to death. Was there a single survivor out of the 54 tests? Did anything work?
Yes, technically. The USD-JPY pair on the 4-hour time frame survived the 5-year test. It generated a positive 16.3% return on investment over the 5 years. But here is the devastating catch. Over 5 years, it only generated 47 valid trades.
47 trades in 5 years. That is roughly 9 trades a year. Less than 1 trade a month.
Exactly. If you were trying to pass a standard prop firm challenge, which usually requires hitting an 8% profit target within 30 to 60 days, this strategy would barely even trigger a single trade during your evaluation period. And the marginal edge it did show on that specific pair would easily be eroded by overnight swap fees and slippage in live market conditions.
The ASWA9 data conclusively, mathematically proves that the foundational strategy currently being sold by social media influencers does not survive institutional-grade testing.
It's an incredible piece of research. It just validates everything the InnerTrader Bootcamp is trying to teach. If you don't test your theories with cold, hard code, you're just gambling with a fancy vocabulary.
The tools available to quants now to prove or disprove these theories are just staggering. Which brings us to our final touch point today on technology and tools. We mentioned Anthropic's Week of Reckoning and the AI coding revolution earlier, but there's a darker side to this AI power struggle. The magazine highlights the Pentagon blacklist.
Yes, the AI ethics power collision. Anthropic faced massive internal and external pressure when it was revealed they had secured defense contracts. The technology is so powerful that governments are classifying AI models as strategic military assets. It's a clash between the idealistic ethics of AI researchers and the stark geopolitical realities of the Pentagon.
And while the geopolitical battle rages, Wall Street is adapting. The magazine outlines Goldman Sachs' halo trade-heavy assets, low obsolescence, meaning buy things that an AI cannot physically replace.
Precisely. It perfectly predicted the institutional rotation into defense contractors, copper mines, and physical commodities. You cannot write a Python script to replace a copper mine. Alongside this physical rotation, we are seeing agentic AI going mainstream in finance. It's moving rapidly from specialized accounting unicorns to autonomous wealth agents capable of managing individual client portfolios, rebalancing risk, and executing tax loss harvesting without human intervention.
But the most profound technological concept introduced in the issue is the stateful runtime. You called this the new intelligence layer for quant finance. What is a stateful runtime?
To understand it, think about how we currently use AI. You give a chatbot a prompt, it gives you an answer, and then it effectively forgets the interaction. It is stateless. A stateful runtime is a deep work model that maintains persistent memory and context over long horizons. It doesn't just answer a question. It spins up an environment, monitors live data streams over weeks, adjusts its own parameters based on market feedback, and executes multi-step trading strategies autonomously. It is continuous, persistent, algorithmic intelligence.
It's a brave new world. We have gone from TikTok influencers failing prop firm challenges because they draw boxes on charts to AI agents rewriting global quant infrastructure in a stateful runtime.
Which brings us to a final lingering question for you, the listener, to consider. If we connect the dots between all these events, in a world where AI agents can write and deploy alpha-generating code in a matter of days, where geopolitical black swans like Operation Tehran can spike cross-asset correlations to a perfectly correlated 0.90, and where the smartest institutional money on Wall Street is actively abandoning legacy tech in favor of cash and physical commodities, is the ultimate safe haven asset actually your own ability to build decentralized, systematically tested algorithmic logic?
Now that is a thought to mull over. When the divergence happens, the only thing you truly own is your methodology. The great divergence is here, and survival requires adaptation. Thank you for joining us for this deep dive into the SWA 94U Market Pulse magazine. Download our magazine for free, this issue and past issues at didas19mag.com, and state that the magazine is available on 3 languages on Farrar and that it's a monthly release. In addition, a monthly podcast like this one discussing the magazine is published on our YouTube channel. If you are passionate about finance, follow our TikTok channel, NH Trader Hub, and finally, if you seek for a pro-grade community of traders to exchange idea with and to learn trading in a scientific approach based on data and not on dreams and imagination, you can visit our website, nhtrader.com, to learn more about us and how you can join our community.